Hello everyone, I hope you all are doing well. Today I'm going to post this lecture because of certain reasons. First of all, as you all might know that this is the admission session, admission test for the new batches to welcome. So we have admission test exam in next weekend. So we have some, departmental and university responsibilities to complete for that, and I'll be in my office and doing some university work the whole day. So that's why it will not be possible to take the class live for this, at least for this class. So that's why I have thought of recording it and posting it so that we don't, really need to go for makeup classes and we don't get pending stuff to complete later on. So this we also have a quiz coming up in next Monday. So for that reason, you need to be really prepared for that. So anyways, we started this chapter. We started the course. We have talked about the course outline. So we have talked about the basic overview, like the definition of finance and scope, and then definition of managerial finance. The main topic starts with the goal of financial management, which is to maximize the wealth and not to maximize the profit because of the certain problems that we have when we consider profit maximization as our ultimate goal. Then we talked about two types of risk and this graph, one of which is the diversifiable and the other is non-diversifiable risk. I have talked with an example, and in fact, we have spent a little bit of time there because many of you have or had some questions on that. So I tried to elaborate this part. This was our last slide where I talked about briefly about the different functions and different areas where the finance guy work. There are long-term decisions and there is a short-term decision, what we call the liquidity decision or working capital management. And for long-term decision, we have investment decisions or capital mix or capital budgeting. Sorry, it's not capital mix, it's long-term asset mix. And the second one is capital mix or financing decision or capital structuring. The first one is basically where to source, where to invest, and the second one is where to source the fund from. And there is another subsidiary of the second function, that is the dividend decision. Because why am I saying it is a function of the second part? Because financing decision deals with where to source from the fund, and this is where the equity and debt comes from. And in equity, we take the dividend decision. So that's why it's a part of the second one. But dividend decision can be considered a separate decision because it's also a long-term crucial decisions that the management needs to make. And I'm saying it's crucial because of the dividend decision, the main ultimate goal, which is the wealth or the value of the wealth or the value of the company in the market, that might change and that gets affected. That's why dividend decision is very crucial. So I have talked briefly about all of these things. Today, what I'm going to do is to finish this chapter and going to pick each one of these functions and talk a little more elaboratively. Okay, first of all, the investment decisions. Decisions are decision of allocation of capital or a commitment of funds to long-term assets that would generate cash flows in the future, which is revenue. Ultimately, why we invest in a project? Because we want the project to generate future cash flows, cash inflows. If you consider the NPV calculation or capital budgeting, what we really do there, we predict the cash flows that this investment will going to generate. So it's simplistically saying that I'm going to invest in today's in some project, and this project will generate some future cash flows. And in investment decision, we really try to understand how much inflows the project or projects will going to give us. And based on that, we make certain decisions. And two important aspects are there. First, evaluation of profitability of projects, which means the determination of future cash inflows or the revenues that I'm going to expect. And the second one is determine the cutoff rate with which the project's rate of return is comparable, which means the cost of capital or required rate of return. So, because if you think about simply the NPV formula, what we do, we divide the future cash inflow, which is the first aspect, with what? With the required rate of return or cost of capital, which is the cutoff rate. Because after we do that, we then also do a certain measure, which is to compare it with the return. Basically, it means the same thing. So you forecast the future cash inflows and you also forecast what the required rate of return or cost of capital might be. So these are two important aspects of our investment decisions. It does not only concern the new projects, but also replacement decisions. That's also important one because sometimes we misjudge an investment decisions. Investment decisions does not only mean investing in new projects. Investment decision also means renovation of the existing projects or replacement of certain parts of the existing projects. For example, let's assume you have a machinery and you think of improving the machinery with some updated parts. Let's say you have replaced one uh, obsolete part and replaced it with a new version of that thing. It's not entirely replacing the new machine, but it's also the replacement of some part which requires some investment. Because what will you think at that time? Just think about that situation. You will compare the additional benefit it will going to bring against to what? Against the investment that you're making by replacing that part. So it will be a cost benefit analysis again, and that's also an investment decision. It can be upgrading the machine, it can be replacing a part of it. Sometimes we face situations like whether to, let's say it's your smartphone and your screen has been broken. So what do? You think about the outcome, like how much money it will cost you to replace the screen or replace the display. Does it worth, for example, for a high-end smartphone, let's say, which values up to a lakh or two. So for these cell phones, we don't mind spending 10 to 20,000 taka on a display. But for a phone of 30,000 value or 40,000 market value, you won't go for a 20,000 taka uh, replacement cost for the display. So that's how you take decisions because what you think, I'm going to have a little bit of less smooth touch with the replaced or artificial or a second version of the display. But you are compromising that thing because you are not going to spend another 1 lakh taka on a high end phone, but you can really do that for a not so high end phone because your the new phone's value will be something around 30,000 and the replacement cost for the display will be 20,000. So it doesn't worth it because it doesn't add that much of value that you're going to spend on it. So that's how you make decisions. These are all investment decisions. You are comparing your investment and you're thinking about the future cash inflows or the benefits it's going to give you in long run. So that's what investment decision is. So, what is financing decision? Financing decision that I've said before, it's where to source the fund from, but it's not only where, it's also when to take the money, from where to take the money, and how much to take the money, because that's also important because it is related to the investment need that you have. For example, you have decided that you're going to invest in a 1 lakh taka project. So, first question, if you take the money now and the investment is going to make after a year, that it's not worth it because you're going to pay certain amount of interest on that. So you are very much to decide when to take it because you are going to take it as late as possible because you don't want to pay more interest on that. And from where? For example, whether to take from liability or to take from equity, or how to proportionately take from both and create a good capital mix for you. So these things really are important when it comes to financing decision. The source of fund can be debt and equity in general, but it's not that simple. For equity, we have certain options. For debt, we have certain options. Debt can be so many types. So for example, it can be a bond, it can be a loan, it can be a corporate loan, it can be so many other options. In fact, if you go to a bank website, the websites which tell you how many options they have. It can be line of credit, it can be certificate of deposit. There are so many things with which a company or a bank can issue debt instruments. And equity are comparatively less complex because there are not many part of it. One is preferred, one is common. We'll go deep into that when it comes to the calculation part of debt and equity. And the challenge, what the challenge of financing decision? The challenge is to find the optimum capital mix or capital structure. Okay, so what do we mean by optimum capital mix? By saying optimum capital mix, we mean what would be the mixture of debt and equity which will give me to serve the ultimate goal, which is the value maximization of the stock or company's wealth. So this is what we need to find. For example, if we take too many debt, let's say 80% debt, then what will happen? The shareholders will find it very risky for the company to keep their investments within. So what will they do? They will sell the shares because it's too risky to invest as a company. So they will sell the shares. And when the sell pressure of the share is high in the market, the stock price will go down and the share wealth or wealth maximization target will be, hampered. So we can't do that. On the other hand, if you take all the money from equity, what can it do? It can rise the cost of capital to a maximum level. So if the cost of capital is too high, the company will not be able to generate high amount of net profit. And if that is the case, then what will you give as dividend to the shareholders? You can't give much money. And in that case, shareholders will not think of it as a good investment because they're not going to get enough return from the investment. They are again going to do the same reaction. What they'll do, they'll start selling out the shares. And if that is the case, then the market value of the share will go down. So, in both of the extreme cases, the share value might go down and the value of the wealth might go down. So we can't let it happen because the ultimate goal of the management is to maximize the share value or the maximize the wealth. So that's why you need to make a good capital mix which serves the purpose. It serves the purpose of having the liquidity. It serves the purpose of not falling into the liquidation crisis by increased amount of debt or not fall in the trap of high cost of capital. So this is where the specialty comes in when they mix it with a very prudency which will serve the purpose. And debt versus equity argument, we will talk in details when we get into that chapter, but I'm going to give you a brief summary. Um, what is the main argument? Okay, first of all, debt is less costly, equity is more costly. Why debt is less costly? Because when I'm an investor, let's say you have a company and I am an investor. If I invest in your company as a debt holder, it means you are bound to pay me. And if it is the case, that means I am doing a less risk investment because I know after a certain time I will get my money back, whether or not you make money or not, whether or not you make profit or not. I will get my money. Otherwise, I have the right to sue you for that. So that's why debt is less risky for me. And you know the risk and return combination. So if the risk for me is less, the return for me is less. And if I am having less return from debt, that means you are paying less in interest on that. So that's why debt is less costly for the issuing company. On the other hand, equity is just the opposite because when I'm investing in equity, I am taking a fair share on the profit and as well as the loss, which means I will ask for more return from that because I am exposed to more risk. I might not get my money back. I might not get my dividend this year. So I am exposed to more risk. And as per the law, if I'm taking more risk, I'm going to expect more return. So that's why my expected return from you and from the other from your perspective, the cost of capital will be high. So that's from the cost perspective. From your end again, it's not only about cost, it has a liquidity effect. For example, the liquidation risk. What do we understand by it? Liquidation risk means the risk of, letting your company's asset portion go. For example, when the debt holders claim, let's say you have high portion of debt, which means you have high interest to pay. If you don't make enough money, what do you need to do? Because you don't have enough net profit to pay off the interest. What do you need to do? You need to sell off certain part of the company. So that's the liquidation part. So you can't have that risk. So that's why the liquidation risk is high on debt and liquidation risk is less on equity. So there are many other arguments, but the company needs to find the optimum mix where they are not exposed to high level of liquidation risk, or neither they are paying a lot of cost of capital. So they need to somewhere balance it out. One of the major concern is to finding the least expensive source of fund, and when we prioritize that, we go towards debt. But again, we can't lean too much toward debt because it will increase the liquidation risk to a high or maximum level, and that can cause trouble for the company. But if we do go to high debt, there are some factors. For example, control, flexibility, legal aspect, loan covenants, which summarize to one factor, which is that if I take too much of loan from debt source, I need to pay a lot of interest. If I pay a lot of interest, I don't have too much of, retained earning from the investment or from the company. So if that is the case, I don't have the flexibility to expand the business. I can't really take certain decisions whether to go for a marketing campaign or to go for a new expansion of new product line horizontally or vertically, doesn't matter. So I am very much, in a rigid situation where most of the cash flows that I'm generating are going into the interest. And what is the legal aspect? The thing that I was talking, that the debt holders can really claim on your profit and really claim on your assets, if not the profit. So these are the legal aspects and the flexibility and control part of financing decision. I think I have cleared it enough as of the first chapter. Then there comes the dividend decision. What it means, financial manager decide what to do with the profit. Okay, what to do with the profit? We do certain things with the profit. First, we pay for dividend, or we retain some part of profit for future investments. So the management can do three things: distribute all profit to shareholders as dividend, retain all of them, or in a proportion. Usually, the third option is the best option that they take into consideration. But again, it depends on many situations. For example, in companies, let's say a company of a food industry or a beverage industry, or a restaurant. So in a restaurant, in the COVID situation, they have struggled a lot. And for a COVID situation, when the struggle is too high, they're not making enough money. So in that case, they're not going to, retain some part of money for reinvestment because they have earned so little. If they start to retain, there will be nothing to pay for the shareholders. So what they do, they might go for the first option, that distribute whatever they have earned to the shareholders to, balance out the share value. But in a situation when the growth is so high for the company, they might also retain that, given that they are, good enough in negotiation to talk it through in the annual general meeting about the retention part and not giving it out, so that it makes sense, because the shareholders will ask for how much wealth they're going to make out of it. For example, how much the share value will be maximized on that retention amount. But usually they don't do this too. The typical practice is to distribute a portion of dividend, and rest will be retained. So that's what they do. Proportion of profits distributed as dividend, that we call is dividend payout ratio. Let's say I have earned 100 taka, and if I pay 40 taka as dividend, I will say that my dividend payout ratio is 40%, and the rest will be retention ratio, which is 60%. It can go other ways too. Let's say I have retained 80 taka out of 100 taka of earning, which means my retention ratio is 100%, and that will automatically make the dividend ratio to be 20%. So that's very plain and simple for you to understand. I'm not going to go into that detail for that. The optimum dividend policy is the one that maximizes the market value of the shares, as we are summarizing all the discussions into one single point, that is to maximize the share value. So how do we do that? Uh, that I was talking about in the previous part, that we need to pay certain amount of money as dividend, otherwise the shareholders will be devastated and they might lose their interest in the company and start selling off the shares, which will negatively affect the share value. On the other hand, if we just keep on paying the dividend and they don't see any net growth in their wealth, which means not to reinvest, not to expand the company, they might also lose the interest on the company because they also think long term. So we need to really find an optimum mix, and that's why they go for the third option: distribute a portion and retain a balance. So that's what you need to do, really, when it comes to dividend decisions. So these are all three, the long-term decisions. Let's talk about the liquidity decision. Liquidity decision, that's a very important understanding. What do we mean by profitability liquidity trade-off? It's a common understanding. You really need to know what this means. Profitability and liquidity trade-off. It's a phrase that institutions commonly use. Think about the situation. You have 100 taka in your bank. You have 100 taka in your bank. Now the decision of how much to take the money and invest and how much to keep as a cushion, as a uh, risk balancing value. If you take all 100 and you invest, if your company is in a situation where a certain amount of cost needs to be carried out, then you don't have any money to do that. So you are trading it off for the liquidity part, and for excess amount of profit you are letting go some part of liquidity. Let me draw this for a better understanding. Let's say you have 100 taka. Now you thought of taking 80 taka for a new investment, which means on 80 taka, let's say the investment will bring you 10% profit. So on 80 taka, you are earning 8 taka, and the rest of the 20 is for the safeguard. You're not spending it, it's in your bank. If some cost comes up, you will pay it with that. So in first case, you are making 8 taka of profit. Now, what can happen if you planning to invest 50 and keep the 50 as a bank balance, on 50% you'll earn 5 taka. So you see, in first portion you were earning 8 taka, now you're earning 5 taka. In exchange of what? In exchange of liquidity. In first case you were earning 8 taka but your liquidity was 20, but in second case, you are earning 5 taka and your liquidity is higher. So basically, you are doing a trade-off in between them, whether you invest the money to increase your profitability or you keep a balance so that it increase your liquidity. So you need to find a, really balance where it's a optimum situation. For example, I was talking about the grocery shop near your house. What they do, they also do the same thing, because they don't really give everything on credit. They don't do that. They have a certain portion of their customers who pay cash and who take the credit. So this is how they balance it out, because the people who are getting the products on credit from them, they actually their profitability source, because this is sort of an investment to keep the customers loyal to the store. So this is how it works. I think you understood it, hopefully, because I have in fact drawn it for you. So that's the liquidity part, and I think it's clearly understood from the discussion. But even if not, then we have the discussion session to clear it out. Okay, the last topic from this chapter is the agency relationship. You have already talked about it in your finance principles of finance course. I'm just going to give a brief example. There are two parts. One is the management, one is the owner. Out of three, as I've discussed before. The other one is the business itself. So the management calls the agent and the owner is called the principal. What is agency problem? Agency problem is not the argument of these two. Agency conflict is not that. Sometimes we tend to misinterpret, because when we see that problem, it's not basically a misunderstanding or a conflict or an argument. Agency problem or agency conflict means the conflict of interest. That's very important. Interest, conflict of interest, not any other kind of conflict. It's not a argument that you're having, it's the conflict of interest. How it happens? Let's say the owners definitely want to get the wealth to be maximized, but if the agent or the management do not work in alignment with that principle, then that's the problem. What can cause this kind of problem? For example, what can happen? Let's say there are two profitable projects. One is project A and one is project B. In project A, the profit percentage is 10%. In project B, the profitability is 12%. So one is 10%, one is 12%. And you can understand, if the company goes for the 12% one, the risk will be higher. But if the company goes for the 10% one, the risk are logically be a bit lower because risk and return relationship is universal. So sometimes the agent might go to the 10% one. There are plenty of reasons. I'm explaining one of them. Even if the shareholders are ready to take up 12% profit in terms of risk that they want to carry, but still the management might go for the 10% one because with additional risk, the management has the fear of losing job. For example, if the project doesn't work, if the company fails, the management will be the one to lose the job first because the owners will be uh, accusing the management why you did the mistake to take the investment decision wrong. So even if the management are, asked or expect to take the high return project, they might not do the same because they have their own interest, which is to keep or retain the job. So that's why there might be a conflict. So that's what we understand by agency problem or conflict. And to resolve that problem, there are certain aspects that need to work on. For example, the incentive part that's most common. We see the promotion and giving profit share. You always see that uh, the sales representative calling for different projects, different products. Let's say your father probably getting hundred of calls for credit card sales and getting extended loans. Do you think that the management or the people or employees do that because they really always care about the profitability or care about the company's wealth maximization? It's not the case. In most often they do that because they get an incentive out of it. So I am providing incentive as owner to the management. So although it might not seem as a agency cost at the first place, but it is an agency cost. How it is an agency cost? Because it is keeping the employees in line with the management goal or the goal of the owner, ultimate goal, which is the wealth maximization. They are keeping it in line with that. So that's how it works. Another thing is the monitoring. Let's say I am keeping advisory role. In many companies, there are advisory roles, which is not a direct a reporting role to any manager, or it's not like that. It's a consultancy role and a management role. So what they do, they really monitor the management's activity and where they're investing, why they're investing, what are the projects available, if there is any reason to conflict or any reason to have any interest of conflict of interest. So these things they monitor and they try to minimize it. So why it is an agency cost? Because if you hire someone to do the monitoring part, you need to pay salary. So that salary will be considered as the agency cost. So if I summarize the topic, there are two parties in agency relationship. One is the agent, one is the principal, and there might be some agency conflict or agency problem. And to resolve or to minimize the agency issues, we are to incur agency cost. So there are three topics in agency relationship. One, what is the relationship itself? What is the problem? And what are the cost? So that's about it from the agency relationship part. I have summarized the topic, although usually I tend to elaborate the agency relationship a little more, but as you have already covered this in your Principles of Finance course, I did not go into that details for this topic. I hope you already know it, and my discussion might help you to clear it out a little bit or to recall the topics. So that's it for this class, and that's it for today's class. I hope I could make you understand what I was trying to convey in this part. So we have a quiz on this chapter, chapter 1, on next Monday, and it will be a short quiz where we will uh, have the short questions, true, false, multiple choice, and this sort. And it will be in Google Classroom, if not physical, and you need to wait for the instructions. If the instructions come by next Wednesday that all the exams will be held physical, then it will be physical exam, but it's less likely to happen because we have the admission test going on this week. So there will not be any decision coming up till next Monday at least. So it will be online, I hope. But even if it's online, I'll make sure that you can only answer if you study. So that's my part of the job. So I'll ensure that. So only option that you have left with is study. So do study. It's only one chapter, and I will ask conceptual questions on that. The times will be very, very, very short. I'm saying it again, the time will be very short, and the purpose of keeping the time very short is to keep you away from unethical means. So I'm being bold enough to say that because it's the fact. You also know that. So that's about it for today's chapter. And one important thing is that today we are not going to have the discussion session. So if you have anything in mind, keep it till our next class. We will have the discussion session on next class. So you can ask me there. So thank you very much for listening to the lecture. Best of luck. Keep well. Thank you.